Most traders lose money for a very simple reason. They see price approaching an area on the chart, they expect a reversal, and they enter without asking one important question. On this chart, there were 3 different areas where a reversal looked possible. The surprising part is that 2 of them completely failed, while 1 led to a clean move with confirmation and a perfect target. So before we look at the outcome, let's see if you can spot what made one area different from the others. Let's start with the first area. The reason this area catches my attention is because price leaves it with a strong bullish move, creating a clear imbalance in the market. Whenever we see this type of aggressive displacement, it tells us that buyers were willing to step in aggressively from this location. So from a smart money perspective, this becomes an area worth monitoring if price decides to return in the future. At this point, everything looks completely valid, and most traders would have no problem considering this area for a potential buy setup. Now let's look at the second area, and honestly, this one looks even more attractive than the first. Not only do we have a strong bullish departure, but price also leaves behind a cleaner imbalance, which is something many traders actively look for when identifying high-probability areas. If I showed this chart to most traders without revealing what happens next, a lot of them would probably choose this area over the first one. Everything about it appears strong, the reaction is clear, and there seems to be enough evidence to justify a potential buy. So at this stage, we now have 2 areas that look completely valid, which raises an important question. If both areas look so good, how do we know which one is actually worth trusting? So far, we have identified 2 areas that look completely valid. Both show strong bullish intent, both have clear displacement, and both seem like reasonable places to look for a buy. But here's where most traders make a costly mistake. They assume that because an area looks good, it deserves their trust. The market doesn't reward good-looking setups, it rewards the right context. And before price gives us the real opportunity, it's about to reveal something that most traders completely overlook. Now, while analyzing the chart, another interesting area begins to form. Just like the previous 2, price leaves this area with a strong bullish move, showing signs of aggressive buying pressure. At first glance, it might not look dramatically different from the other areas we've already identified. In fact, many traders would probably place all 3 in the same category. But this is where things start to get interesting. Because if all 3 areas appear valid, yet only one eventually delivers the move we're looking for, then there must be something happening behind the scenes that we're not seeing yet. And that's exactly what we're about to uncover. Eventually, price returns to the first area, and this is exactly where many traders would be looking for a buy. The reaction initially looks promising, as price shows signs of respecting the area, giving traders confidence that the setup is working. But if we keep watching, something important becomes clear. Despite the reaction, price fails to generate the strong bullish expansion that traders were expecting. In other words, the area produced a reaction, but a reaction alone is not enough. And this is the first clue that there's a big difference between an area that simply reacts and an area that is capable of delivering a real move. After breaking below the first area, price continues moving lower and reaches the second area. Now, because this area looks even stronger on the chart, many traders would expect a significant bullish reaction from here. But instead of respecting the area, the market does something completely different. Price slices straight through it with strong bearish momentum, showing almost no interest in reversing from that location. At this point, we know something important. The market isn't rejecting these areas by accident, it's deliberately moving through them. The question is, what is price actually searching for? At this point, 2 completely valid-looking areas have already failed. The first one couldn't generate a meaningful move, and the second one was broken with aggressive bearish momentum. So if the market is ignoring areas that most traders would happily buy from, then something is clearly missing from the analysis. And that's exactly where the biggest clue on this chart begins to appear. Because when we look at what price did before reaching the final area, we start to understand why the first 2 never stood a chance. Now the chart starts to make much more sense. The first area that failed is no longer just an area of interest. It becomes a source of liquidity. Then, as price continues lower, the second area serves the same purpose. In other words, the market wasn't respecting these areas because it was still collecting liquidity from them. This is why price kept pushing lower instead of reversing. What looked like failed buying opportunities were actually becoming liquidity pools. And once that liquidity had been collected, the market was finally in a position to reach the next area with a completely different objective. Eventually, price reaches the third area, and this time the reaction immediately feels different. Instead of drifting away or showing a weak bounce, the market leaves behind a strong rejection wick, followed by aggressive bullish displacement. That's our first sign that buyers may finally be stepping in with real intent. But despite seeing a strong reaction and a clear displacement, this still isn't enough for me to enter the trade. A lot of traders would already be looking for a buy here, but I need one more piece of confirmation before risking any capital. And that's exactly what price is about to give us next. After that strong displacement, price leaves behind a fair value gap, which is exactly what I wanted to see. The displacement tells me that buyers are becoming aggressive, and the fair value gap gives me evidence that the market moved so quickly it left an inefficiency behind. This is important because strong moves often revisit these inefficiencies before continuing in their intended direction. So instead of chasing the move, I'm now waiting patiently to see whether price will return to this gap. If it does, and the market shows the right behavior, that could provide the final confirmation I've been waiting for. A short time later, price does exactly what we're waiting for. Instead of continuing higher immediately, it retraces back into the fair value gap and begins to show signs of support. This is the confirmation I needed, because now I have three things aligned: a strong rejection from the area, aggressive bullish displacement, and a return into the imbalance created by that displacement. With all of these factors working together, the probability of the trade increases significantly. This is where I execute my entry, place my risk below the low, and target a clean 1 to 3 risk to reward setup. From here, it's simply a matter of letting the market do its job. Now let's talk about the biggest lesson from this entire setup. Most traders focus only on finding an area where price might reverse, but that's exactly what causes them to lose money. If you look back at the first two areas, both of them looked completely valid. They had strong departures, they looked clean on the chart, and many traders would have been comfortable taking a buy from either one. But the market doesn't care how good an area looks. What matters is the context behind it. The first area failed to produce meaningful expansion, while the second one was broken with strong bearish momentum. These weren't random failures. The market was still searching for liquidity, which means the conditions for a high probability reversal simply weren't there yet. This is why blindly buying every area can be so dangerous. The real opportunity appeared only after liquidity had been collected. Price reached the final area, produced a strong rejection, delivered bullish displacement, and then provided additional confirmation through the fair value gap retracement. So the lesson here is simple. Don't trade an area just because it exists. Wait for the market to prove that it's ready to move. When context, liquidity, and confirmation align together, that's when high-quality setups begin to appear. And that's exactly why only one of these areas was worth trading. The first two may have looked attractive, but without the right context, they never had a real chance of delivering the move traders were expecting. The third area was different. Because liquidity had already been collected, the market showed a strong rejection, delivered displacement, and then provided additional confirmation before the entry. Hopefully this breakdown helped you understand the difference between an area that simply looks good and an area that's actually worth risking money on. If you found value in this lesson, make sure to subscribe, and I'll see you in the next breakdown.